Right now, somebody is going to lose their house. Not because they gambled, not because they were reckless, because they did exactly what they were told to do. They saved a little, they got the mortgage, they paid on time, and none of it mattered, because the rules they followed were written for a game that stopped existing decades ago. You were taught that a dollar is a dollar, that saving is safe, that hard work compounds into security, and every single one of those ideas is incomplete or flat out wrong, depending on who you ask and when you ask them, because here is what nobody sat you down and explained. That $100 bill in your wallet, the one that feels so permanent, so authoritative, with its dead president and its fine print, contains roughly 12 cents of actual material. Cotton, linen, ink, 12 cents. The other $99.88 of its value exists entirely because you and 330 million other people have collectively agreed to pretend it does. That is the mechanical reality of every transaction you have ever made. And it gets worse, because at least that bill is something you can hold, you can fold it, you can feel the paper between your fingers. But only about 8% of all the money on Earth exists in that form. The rest, the other 92%, is nothing more than entries in databases, electronic signals, numbers on servers, humming in climate-controlled rooms you will never see. When you check your balance, you're not looking at a stack of cash in a vault with your name taped to it. You're looking at a promise, a record, a flickering digit that the entire civilization has agreed to treat as real. And the moment that agreement fractures, even for a few hours, the consequences are catastrophic. Entire economies have collapsed, not because the gold ran out or the crops failed, but because enough people stopped believing at the exact same time. This is the foundation your financial life sits on. Not rock, not steel, belief, shared fiction, the single most successful shared fiction in the history of the species. Sure, but fiction all the same. Go back further and it gets even stranger. Before money existed, you had barter. And barter has a flaw so fundamental, it has a name, the double coincidence of wants. You need shoes. I cut hair, unless you happen to need a haircut, and I happen to need shoes. At the exact same moment, we both walk away with nothing. Scale that across a village, a city, a continent, and everything seizes up. So humans improvised, shells became currency in ancient China. Roman soldiers received part of their wages in salt, which is literally where the word salary comes from. Think about that the next time you see your paycheck deposited. You're still being paid in a descendant of seasoning. Cattle served as money, tobacco served as money in colonial America. Then, around 700 BC, someone in Lydia, modern-day Turkey, figured out you could stamp a chunk of metal, a natural gold and silver alloy called electrum, into a standardized disc, and suddenly wealth was portable. You didn't have to drag a cow to the market anymore. Paper came next. China figured that out roughly 1,000 years ago. Merchants swapped receipts instead of hauling metal. Marco Polo saw it and wrote about it like he'd witnessed sorcery. Europeans thought the entire concept was lunacy. They eventually changed their minds, obviously, but for centuries, paper money had a leash. Governments could only print as much as they had gold, sitting in a vault to guarantee it. Every bill was, at least in theory, exchangeable for a fixed weight of the real thing. Then came a Sunday night in August of 1971. Richard Nixon sat in front of a television camera and severed the dollar from gold. Just like that, one broadcast. Before that moment, your money was tethered to something physical, something scarce, something you could melt down and weigh. After that moment, every dollar and every major currency that followed was backed by exactly one thing: a government's word. That is what fiat means, from the Latin, let it be done. The state declares it has value. You accept that declaration, and the entire global economy hums along on that acceptance, like a jet engine running on trust instead of fuel. Now sit with that for a second. You've spent your entire working life chasing, saving, and stressing over something that a government can create from thin air by typing numbers into a terminal, while you traded hours of your life for each dollar. Somewhere else, a central bank conjured 100 billion of them before lunch with a single keystroke. Not metaphorically, literally, and the people who understand how that mechanism works, the people who sit in those towers and move those levers, They are not smarter than you, they're not more disciplined, they simply learned the rules of the actual game, while you were still playing by the rules of a game. That ended half a century ago. And those levers, the ones that silently reshape the cost of your rent, your car payment, whether your employer can afford to keep you on payroll next quarter, those are controlled by institutions most people cannot name, and mechanisms most people have never heard explained in plain language. Central banks, the Federal Reserve, the Bank of England, the European Central Bank. They don't have ATMs, they don't take walk-ins, they are the banks that banks answer to. The operating system underneath every financial decision you will ever make. And the single most important dial they control. The one number that cascades into every corner of your financial existence. Just hit its highest point in 23 years. The Fed pushed rates to 5.25% to 5.5%, and that one adjustment rewrote the math on every mortgage, every car loan, every business expansion in the country. You felt it, you may not have known why, but you felt it in the payment that jumped, in the approval that got denied, in the raise that never came. Everything you thought you knew about how money works, about saving, about earning, about what makes something valuable. It was built on a foundation most people have never actually examined, and the cost of not examining it is not abstract. It shows up in your account balance. It shows up in the interest rate you accepted without negotiating. It shows up in the fee you paid without questioning. So before we go any further, before we talk about what these institutions actually do behind closed doors, and how their decisions land directly on your kitchen table, understand this one thing clearly. The system was not built to be understood by you. It was built to function whether you understand it or not. And that difference has been costing you money every single day you've been alive. When your bank approves a mortgage, it doesn't go into some back room, pull existing dollars from a pile, and wire them to a seller. It credits your account with brand new money. Money that didn't exist 5 minutes before your signature dried. The loan creates the deposit. Your debt is someone else's asset, which means the entire money supply swells when banks feel generous, and contracts violently when they get nervous. That is why a credit crunch doesn't just slow the economy down, it chokes it. Now zoom out and look at the scale of the machine doing this. JP Morgan Chase alone holds $4.56 trillion in assets. That is more than the entire GDP of Germany. The big four U.S. banks combined sit on over $15 trillion. These institutions are not middlemen passing your savings to borrowers. They are the circulatory system of the economy. Every heartbeat of commerce, every payroll deposit, every mortgage payment flows through their arteries. And the thing about a circulatory system is that when it fails, nothing else matters. So how do these banks actually make their money? They borrow cheap and lend expensive. Your savings account pays you almost nothing. Your mortgage, your car loan, your credit card, those cost you plenty. The spread between what they pay you and what they charge you is called the net interest margin, and it is one of the most profitable gaps in the history of capitalism. You're on the wrong side of that gap every single month. Now pull back further and look at what the people controlling the thermostat have been doing. Before the 2008 financial crisis, the Federal Reserve's balance sheet Saturday at around $900 billion. After the crisis, it ballooned to $4.5 trillion. Then COVID arrived, and by early 2022, the balance sheet hit $8.9 trillion. That is a nearly tenfold increase. For perspective, that single number is larger than the entire economic output of Japan. The Fed didn't print physical bills. It created digital reserves by typing numbers into a computer. Quantitative easing, they call it, sounds clinical. What it means is the central bank bought government bonds on a scale that would have been considered insane a generation ago, flooding the financial system with liquidity to keep everything from seizing up, combined with $5 trillion in fiscal stimulus from Congress. The U.S. government effectively created roughly 40% of all dollars that had ever existed in less than 2 years, 40% of all the money ever in under 24 months. Read that again and let the weight of it settle. Nearly half of every dollar circulating on the planet was conjured into existence. During a period shorter than a gym membership you forgot to cancel. The bill arrived in 2022. Inflation hit 8%, the highest since the early 1980s. The Fed responded with the most aggressive rate hiking cycle in decades. slamming the brakes after spending 2 years flooring the accelerator. And that whiplash, that violent correction, broke banks. We will get to exactly how in a moment, because here is the catastrophic vulnerability nobody talks about at dinner parties. The entire system cannot survive a moment where too many people want their money back at the exact same time. Banks lend out far more than they actually hold. If depositors panic and show up all at once, the math collapses. The FDIC, created in 1933 after roughly 9,000 banks failed during the Great Depression, insures your deposits up to $250,000. In 90 years, no insured depositor has ever lost a penny. That guarantee, that single promise, is the only thing standing between a normal Tuesday and total financial meltdown. It is not the vault doors or the security guards or the marble lobbies keeping the system intact. It is a belief, backed by a government agency, that your money will be there when you ask for it. The entire architecture of modern banking rests on the assumption that you will not all ask at the exact same time. And for 90 years, that assumption mostly held until it didn't. So now you understand how money gets conjured and multiplied. But here is the part nobody wants to say plainly. All of that creation, all of that multiplication, it flows through a set of institutions that were never built for you. And the distance between you and them is not measured in effort. It is measured in which side of the transaction you are standing on. That is the value layer nobody explains in a finance textbook. There is the layer that creates deals, the layer that gets early information, and the layer that provides the liquidity. You are the liquidity. You are the exit. When an investment bank takes a private company public, it is not performing a public service. It is running an auction where the best seats were filled before the doors opened. The IPO price was set. The institutional allocations were locked. By the time shares appeared on your screen, the most informed money in the room had already decided whether to hold or dump. Now scale that logic up. Investment banks don't just run IPOs. They advise on mergers, structure bond offerings, arrange leveraged loans. They sit at the exact center of every major capital movement in the global economy. When one company buys another, armies of analysts work through the night, figuring out whether the target is a diamond or a dumpster fire in a nice suit. They advise both sides of the deal. Think about that for a second, both sides, and they charge generously for each. They're the high-powered real estate agents of the corporate world, except instead of 6% on a $500,000 house, they're skimming fees off transactions worth billions, and when the incentives get twisted enough, the results are spectacular. Consider what happened with Malaysia's sovereign wealth fund, 1MDB. Goldman Sachs arranged $6.5 billion in bond offerings. The fees were so abnormally high that Goldman's own people internally flagged them as a potential regulatory concern. $4.5 billion of that money was stolen, not misallocated, not poorly invested, stolen. The proceeds funded a $250 million yacht, luxury real estate across 3 continents, Picasso paintings, and in a detail so absurd it reads like satire. Some of the stolen money financed a stake in The Wolf of Wall Street, a film that is literally about financial fraud. Goldman paid $2.9 billion in regulatory fines worldwide, and another $3.9 billion in a settlement with Malaysia. And internally, one of the 1MDB deals had previously won one of Goldman's most prestigious awards for creativity and entrepreneurial thinking. The system rewarded the result. It asked questions much later. So where does that leave you? The person with a brokerage account and a monthly contribution. You're buying shares. A share is a fractional ownership stake in a company. Simple enough. When Apple issues stock, it sells pieces of itself, so it can raise money without borrowing. You buy a piece, you technically own a fraction of Apple's cash products, future earnings, and voting rights. The entire U.S. stock market now represents roughly $62 trillion in market cap. The S&P 500, tracking 500 large companies weighted by market cap, is the benchmark everyone refers to when they say the market went up or crashed, and the long-run case is genuinely compelling. The S&P 500 has returned an average of 10.4% annually since 1928, about 7.3% after inflation. Consider someone like Sarah. She put $200 a month into an S&P 500 index fund starting at 22 and never looked at it again. No stock picking, no timing, just automatic contributions every month. At 65, Her account holds just over $1.1 million. She didn't beat the market. She didn't need to. She let time do what time does. That is the story everyone tells because it is true, but it is also incomplete. Because the value you're being offered as a retail participant and the value being captured by the institutions, arranging, underwriting, and front-running the same markets, are not the same value. You get the long-term average. They get the fee on every transaction that creates that average. You absorb the drawdowns. They earn whether the market rises or collapses. You are the patient capital. They are the permanent toll booth. That is the real stratification. Not between people who work hard and people who don't. Between people who own the infrastructure of wealth creation and people who feed into it monthly, hoping the math holds over 43 years. This is not a theory. In early 2020, the S&P 500 dropped 34% in 33 days, the fastest collapse in recorded history. People panicked, people sold, people said they would get back in when it made sense. And the ones who stayed, the ones who did nothing, the ones who felt nauseous watching their accounts bleed, they caught the snapback. The market doubled in under 2 years. The people who got out and waited for clarity are still trying to figure out when the right moment was to get back in. That moment never announces itself. It just passes, and you only recognize it in the rearview mirror. Warren Buffett put $1 million on the table in 2007. One side of the bet, a single S&P 500 index fund. The other side, 5 hand-picked funds of hedge funds, chosen by a professional whose entire career was selecting the best managers in the industry. 10 years, the index fund returned 7.1% annually. The hedge funds returned 2.2%. Not even in the same universe. The boring, automatic, no genius, required index fund destroyed the combined brainpower of Wall Street's elite. And it wasn't a fluke. It was the fee structure eating the returns alive, year after year, compounding in reverse. So here is what you actually do. And I need you to hear how small this is. Because your brain is going to reject it as too simple. You open one account, a brokerage account. Not tomorrow, not next month, today. You pick a single broad market index fund, the kind with an expense ratio so low it rounds to zero. And you set up an automatic transfer. The same amount, every single month pulled from your checking account like a utility bill. $50, $100, whatever you can do without thinking about it. And then you do the hardest part, you do not touch it. You do not check it daily. You do not sell when the market drops. You do not chase whatever stock your cousin is suddenly excited about. You do not watch financial news at 10 p.m. and rearrange your portfolio at midnight. You treat it like a bill you pay to your future self. And you forget it exists. That is not a strategy, that is a machine. You're building a machine that removes you from the equation because you are the problem. Your fear is the problem. Your cleverness is the problem. Your timing is the problem. The machine does not panic. The machine does not get greedy. The machine does not watch bond yields at 2 in the morning and convince itself the world is ending. It just buys, same day, same amount, month after month after month. And it will outperform nearly every hedge fund manager alive. Not because it is smart, but because it is incapable of being stupid. The gap between you and the people in the glass towers is not intelligence, it is not access. It is the willingness to do something boring, consistently for long enough, that the math starts to work in your favor instead of against it. Every fee you do not pay is a return you keep. Every panic sell you do not make is a recovery you get to ride. Every month that auto transfer hits, you're buying the future at whatever price it happens to be that day. And over time, the average of all those prices is lower than almost any entry point you would have chosen yourself. That is where most people land after watching a video, like this one, full of new information, genuinely more literate than they were an hour ago, and absolutely paralyzed. Because knowing how the machine works is not the same as knowing what to do. On Monday morning, when you have $847 and a rent check due on the 1st, that distinction matters more than you think. Go back to every disaster we walk through in this video, every single one of them. The banks that lent money they did not have. The hedge funds that charged 2 and 20 to underperform a fund you could buy for the cost of a streaming subscription. The private equity firms that loaded companies with debt, stripped them for parts, and walked away richer while employees walked away with nothing. The moment in 2008 when the entire global credit system nearly seized because of 3 cents on a money market fund. Every one of those catastrophes had victims. And in almost every case, the victims were not the people who understood the system. The victims were the people who trusted it without understanding it. The homeowner who signed the adjustable rate mortgage because the broker said it was fine. The retiree whose pension fund was 40% allocated to assets that turned out to be worthless paper. The small business owner whose credit line evaporated overnight because a bank 3,000 miles away made a bet that went sideways. Those people were not stupid, they were not lazy, they were simply operating inside a machine that was never designed to protect them, and nobody had ever explained to them how the gears actually turned. You are no longer one of those people. That is not a small thing, that is your survival buffer. Remember Jim Simons, the mathematician whose fund returned 66% annually for 30 consecutive years. The man who turned $100 into roughly $400 million. Remember what made that possible. It was not conviction, it was not vision, it was not reading the right book or watching the right video. It was a team of PhD mathematicians and physicists, running algorithms across millions of trades, exploiting an edge so thin it was barely better than a coin flip. 50.75% accuracy, that is all. Half a percentage point above random chance. Executed at a scale and speed that no human being, sitting at a kitchen table, could ever replicate. And even then, Simons kept the fund closed. He didn't let outside money in, he didn't sell the strategy, he didn't write a book about it. He kept the best machine for himself, because he understood something that most people in finance will never admit out loud. The edge is fragile, the edge is narrow, and the moment you start believing you have a bigger edge than you actually do, the market will correct that belief with your money. So no, I'm not going to sit here and tell you that you're now equipped to go out and generate $72,000 by Christmas. I'm not going to tell you that $5,000 and the right strategy will change your life by next quarter. I'm not going to tell you any of the things that the comment section is buzzing about, because those stories, as inspiring as they are survivorship bias wearing a party dress. For every person who turned a small account into a life-changing number, there are thousands who turned a small account into zero and never posted about it. You don't see them in the comments, you don't see them in the thumbnails. They're sitting at kitchen tables of their own, in silence, wondering what went wrong. And that understanding changes the math of your life in ways that do not show up on a brokerage statement. You now know that an index fund charging less per year than your Netflix subscription outperformed an army of Ivy League hedge fund managers over a decade-long bet. 7.1% versus 2.2%. That is not a marginal difference. Over 20 years, on $100,000, that gap is the difference between roughly $387,000 and roughly $54,000 in growth. One number changes your retirement, the other one does not. And the one that changes your retirement required zero skill, zero timing, zero Bloomberg terminal, zero anxiety. It just required you to not do the thing that feels smart. It required you to do the boring thing and then walk away. You now know that the debt placed on a company by a private equity firm lands on the company's books, not the firm's, which means the next time you see your employer get acquired, and the new owners start talking about efficiency and optimization and unlocking value, you understand what is actually happening. They borrowed money to buy the place where you work, and your labor is going to pay back that loan. Knowing this does not stop it from happening, but it does mean you start updating your resume before the second round of layoffs, not after. It means you start building a financial cushion while the paychecks are still coming, not when they stop. That is not cynicism, that is pattern recognition. And pattern recognition in a system this large and this indifferent to your well-being is the closest thing to a superpower you are going to get. Without a Bloomberg terminal and a math degree from MIT, you now know that 3 cents on a dollar nearly ended the global credit system. A single money market fund breaking the buck triggered a panic that froze lending across the entire planet, which means you understand, at a visceral level, that the stability you feel when you look at your bank balance is not structural, it is psychological. The system is more fragile than it looks, the safety nets are thinner than advertised, and the people who are supposed to be managing the risk are, in many cases, the same people who created it. That knowledge does not make you paranoid. It makes you the person who keeps 3 months of expenses in a place. That is boring and liquid and accessible. Not because you think the world is ending, but because you've seen what happens when the people who are supposed to prevent endings decide to take a long weekend. Here is what you actually do with all of this. And I mean actually, not theoretically, not in some idealized future where you have more money, more time, and more confidence. Right now, with what you have, with the checking account balance you looked at this morning and felt that familiar knot in your chest. First, you stop trying to be smart with your money. That is the single most expensive instinct in personal finance. The desire to be clever, the desire to find the angle, the desire to pick the stock that nobody else sees, to time the dip, to get in before the crowd. That instinct has cost more people more money than any recession, any crash, any Ponzi scheme in history. Because the opposite of being smart with your money is not being stupid. The opposite of being smart with your money is being consistent. And consistency over time, in a system that rewards patience and punishes cleverness, is the single most reliable wealth-building behavior available to a human being who does not have access to a closed algorithmic trading fund. Second, you audit every fee you are currently paying, every single one. Your bank account, your retirement fund, your credit cards, your insurance, every monthly subscription that touches your financial life. You look at each one and you ask a very simple question. Is this fee buying me something I actually need? Or is it buying someone else a boat? Because the difference between a fund that charges 0.03% and a fund that charges 1% does not feel like anything in a given year. But over 30 years on a modest portfolio, that difference is a house. That is money that left your life and entered someone else's. And it left so quietly, you never even felt it go. You are now the person who feels it. You are now the person who checks. Third, you build what I would call a survival buffer. Not an investment portfolio, not a retirement account, not a brokerage position, a survival buffer. Cash, boring, unsexy, earns almost nothing cash. Sitting in a high-yield savings account or a money market fund, enough to cover 3 months of your actual life. Not 3 months of your ideal life. 3 months of rent, groceries, utilities, the minimum payments on whatever debt you carry, and gas to get to a job interview if the worst happens. That buffer is not an investment. It is not going to compound you to freedom. It is going to keep you from making the desperate decision, the one where you sell your index fund at the bottom because you need to make rent, the one where you take the predatory loan because the alternative is an eviction notice, the one where you cash out your retirement account early and eat the penalty because you have no other option. Every single catastrophic financial decision that ordinary people make can be traced back to the absence of a buffer. Not the absence of knowledge, not the absence of strategy, the absence of time. The buffer buys you time. Time is the only asset in the financial system that cannot be manufactured, leveraged, securitized, or sold to you at a markup. Guard it. Fourth, you exercise your right to exit. And this is something nobody in the financial industry wants you to know you have. You have the right to leave any fund, any advisor, any bank, any product at any time. If someone is charging you fees you do not understand, for performance you cannot verify, you leave. If an advisor cannot explain to you in a single paragraph what they are doing with your money and why, you leave. If a financial product requires a 40-page prospectus, written in a language that appears to be English, but does not behave like English, you leave. The financial system is built on the assumption that you will stay, because leaving feels complicated and scary and like you might be making a mistake. That assumption is correct for most people. It does not have to be correct for you. You now know enough to identify when someone is profiting from your confusion. The correct response to that identification is not anger. It is not a complaint letter. It is movement toward the exit, toward something simpler, toward something you can explain to yourself in your own words. At 11:43 on a Tuesday night without needing 9 browser tabs. Fifth, and this is the last one, because if I give you more than 5 things you will do, none of them. You accept that the system is bigger than you. You accept that you cannot beat it, time it, outsmart it, or escape it. You accept that every dollar you earn, spend, save, and borrow passes through a machine that was designed by people who are not you, for purposes that are not yours. And then, having accepted all of that, You make the only rational decision available. You learn the machine well enough to stop feeding it more than you have to. That is all this is. That is all any of this has ever been. Not a path to wealth, not a secret formula, not a hack or a shortcut or a system. It is literacy, financial literacy, the kind that does not make you rich, but makes you significantly harder to make poor. The kind that means when the next crisis comes, and it will come, because the machine runs on cycles, and the cycles have not been repealed, you will not be standing in the blast radius, wondering what happened. You will be the person who saw the inverted yield curve 3 months before the headlines. You will be the person who already had the buffer. You will be the person who did not panic sell at the bottom, because you understood that a 34% drop in 33 days, while terrifying, is also something that markets have recovered from every single time in recorded history. Not quickly, not painlessly, but completely. You will be the person who is harder to take advantage of. In a system this large, this powerful, and this deliberately opaque, that is not a consolation prize, that is the whole game. Now look, I need to be honest about something else before we wrap this up, because it would be dishonest not to say it. Watching this video does not change your financial life. I know that sounds strange after everything we have covered, but it is the truth. Information without action is entertainment. And entertainment, no matter how educational it feels in the moment, does not compound. It does not grow, it does not build a buffer. It sits in your memory for about 72 hours. And then it gets replaced by the next video, the next article, the next alarming headline about the economy. The only thing that changes your financial life is a decision made in the next 48 hours. Not a big decision, not an irrevocable decision, not a decision that involves $5,000 or a brokerage account, or a phone call to a financial advisor. A small decision, the kind of decision that feels so minor that you almost do not bother. Open your retirement account statement, the one you have been ignoring, not to do anything with it, just to look at it. Find the expense ratio. That is a number, usually expressed as a percentage. That tells you how much you are being charged per year for the privilege of having someone else manage your money. Write that number down. If it is above 0.5%, you now have a question to answer. And the act of answering that question, of looking at the number and deciding whether it is justified, is the first time in your financial life that you are operating with your eyes open inside a machine that depends on you keeping them closed. That is not a fortune. That is not freedom. That is not $72,000 by Christmas. It is something better. It is the beginning of a pattern, where you look before you sign, question before you trust, and calculate before you hope. And in a system that has spent decades engineering the opposite pattern, that is worth more than any stock tip, any signal group, any algorithm, any course with a money-back guarantee that you will never actually test. You are still inside the machine. You will always be inside the machine.